Hello and welcome to today's webcast. We're really glad you all could join us. I'm Sarah Weatherspoon. I'm the Director of Wealth Management at Private Ocean, and I am with Sabrina Lowell, Kevin Gahagan, and Zach Schlott today. Sabrina Lowell, many of you know her already. She is a senior advisor and principal with Private Ocean. She's also the managing partner of our once and future San Francisco office. Kevin Gahagan is also a senior advisor and also a principal with Private Ocean and a longtime member of our investment committee. We also have Zach Schlott, our investment research analyst, who some of you may not have seen in person yet. Zach leads our investment research efforts and works very closely with Fred Dotfell, the chair of our investment committee. So our topic today, we are here to talk about what's next for investors. We're going to cover 2020 thus far. We'll cover the current environment, including the economy, markets, the political landscape, and COVID, as well as what's ahead. And lastly, we'll cover current and future tax policy. For those of you who sent questions in advance to us, thank you. We appreciate those and we'll address some of them today. We've also forwarded them to your advisors specifically to follow up with you after. So again, thank you. Glad to have you, and let's dive in. So Zach, hoping to start with you. Could you give us just a brief synopsis of all that has happened here in 2020?
Yeah, absolutely. And I'm just going to share my screen here. We've got a couple of slides prepared for today. And I know, the last 11 or so months have certainly felt like 11 years or so. So I think it's worth just kind of diving back into what's happened thus far this year. And we'll just go through and highlight some of the key events that happened this year to set the stage for this conversation. So back here in January and really starting in December of 2019, we knew that the virus was coming. We had started to see its impact in Asian markets, particularly in China. We saw it happen in northern Italy and slowly spread to other parts of Europe, and then it finally made its way here to the U.S. And back in starting in February, end of February, there is really where we started to see what is now known as this Corona crash. There's a lot of volatility happening. Some days you're seeing circuit breakers hit and the market's dropping 10, 12%. Other days the market is rallying. And you started to see the Federal Reserve step in a little bit and offer 700 billion in liquidity help during this period. And really, as they're cutting interest rates, as they're starting to offer some sort of backstop for the rest of the economy, it gets to a point where it just isn't enough to help that liquidity crunch that we saw during this period. So fast forwarding to March 23rd, that's when the Fed steps in with unlimited quantitative easing right here. And that really signals the market bottom for the Corona crash. Investors started to feel a little bit more confident that the Federal Reserve is going to step in and do whatever it takes to help aid the economy and again be that liquidity backstop. A couple of days later, we see the CARES Act finally signed into law, and some of that cash being distributed to those that are most impacted. We start to see the beginning of the PPP program for those small businesses that are heavily impacted. Moving along, this date here, April 20th, really starts to feel like a blip on the radar relative to all the everything else that happened. But essentially, oil markets crashed to negative prices. It hit negative $37 a barrel, and that was on the back of the demand shock that we saw from lockdowns. People are starting to or stopping that, taking flights. They're not driving into the office any longer. Even things such as cargo ships are being holed up in ports. So you really start to see the demand shock ripple through the rest of the economy. Moving along to the summer period, June, there really was this idea that maybe warmer weather would help stimmy some of the coronavirus spread. And again, we were just trying to figure, and still are, really, as new information is coming to light, we're really starting to, understand things a little bit better. But obviously back then, the concern regarding a second wave really kicked up. We saw market sell off. That led into June 26th. We start to see, multiple months of economic data. We start to see the unemployment numbers coming out and not really getting better. We start to see that surge in infections. It really called it the second wave, but it's all really, part of that first wave. We start to see the GDP figures, which obviously were pretty bad. And then as we head into September, we really start to get in that election season. We start to get those kind of pre-election jitters in the market. We saw that kind of that sell-off happen that week before the election as there's uncertainty in the market. And then once the election actually begins to happen, we start to see a rally in the market. And that really stems from, okay, now we have a better idea of what the election outcome might be. Volatility starts to subside, the markets rally. I think there was a little bit of that rally could be attributed to, the split Congress that we anticipate to be voted in. Obviously, we're still waiting on the Georgia special election, but that really might signal, okay, maybe there won't be additional tax policy put in place. So there's obviously a lot of noise going on in the more recent period. We also saw the markets rally on the back of the positive vaccine news that we saw, last week. So, and into this week as well. So again, it's tuning out some of that noise and trying to understand, what's going on with the election, what's going on with the vaccine and the virus itself. But really, we're starting to see a market rally as there's some of that uncertainty subsiding.
Zach, you're so right about this feeling like a very long 11 months. Can you talk a little bit too about what actions we've been taking in clients' portfolios during this time?
Yeah, absolutely. And if we just jump back to this period here, this drawdown here, this is where our investment operations team, our portfolio managers, are really busy rebalancing portfolios. And when we have large sell-offs like this, you know, investors tend to flock towards less risky assets like fixed income, alternatives. And what you start to see is when we're rebalancing the portfolio, we're selling out of those things that are doing relatively well. Obviously, equities are red at this point and doing poorly. But on a relative basis, fixed income alternatives, they're doing a little bit better. So you might see, some sells in fixed income and alternatives. We're buying into equities at more attractive valuations and sort of buying into that dip in the market. And then what's also going on here is during this rebalancing process, we're actually harvesting those losses on those equities. And then we're going to buy back into the market. And what you'll have is tax losses that you can write off against future gains. And that really enables our portfolio managers and investment operations team more broadly, more flexibility in the portfolio when we're trying to raise cash for distributions or when we're trying to rebalance the portfolio. So yeah, I mean, there was a lot of trading that was going on. There was a lot of activity in the investment operations department, certainly during this downturn. And then, as we're having client annual reviews and as we're going through this period, if there's any opportunities and additional pullbacks like we saw in June, or even in early September, if there's opportunities there, we're also looking to take advantage of that as well.
Zach, I know we all appreciate the rebalancing, the buying investments at lower relative prices, and also the banking of those losses that we've been able to harvest. So thanks for that summary. Let's turn to where we're at currently. Kevin, can you speak to the prospects that you see for the economy, just given where we are today?
So let me touch on a few areas, if I may. I'll talk a little bit about economic growth, inflation, and Fed policies, Fed's their policy posture, and in fairness, these comments derive from research and commentaries from our corporate partners, as well as a range of economic and market conference calls that we participate in. And this said, there is a saying that prediction is very difficult, particularly when it's about the future. And so I think with that caveat, clearly the pandemic, and as Zach was pointing out with the slide, clearly the pandemic has had, a tremendous impact, adverse impact on the economy. And so, while we have seen significant improvement from the trough that we saw, on the graph that Zach shared, the fact of the matter is, GDP numbers, gross domestic product, is expected to be in the negative range for the year. We saw a decline in GDP we hit somewhere in well below 10% at the trough. Current projections are a lot of improvement that we've seen. We're still seeing and estimating a negative GDP number somewhere around 7 to 8% relative to 2019. With optimism that these numbers are going to improve markedly in the coming year. Looking at 2021, the real progress as it relates to the economy is going to be dependent upon our ability to successfully combat the COVID virus. And obviously in that regard, the news of vaccine is a game changer. Even with the surge in infections that we're currently seeing and that are concerns as we go forward, the announcement of Pfizer and Moderna both in producing a vaccine with ostensibly very high effectiveness rates is very promising and is likely to, as it rolls out, to help alleviate some of the concerns in terms of the surges, and hopefully contribute to a further reopening of the economy. So forecasts that we're hearing looking for next year are that real economic growth, that is economic growth over the rate of inflation, is projected to be in the 1% to 2% range. And, as a reminder, Fed's target for inflation, they're shooting for 2%. We've been below that. But in fact, currently inflation is at about 1.6%. So if we bump up to that 2% level, or somewhere where we're somewhere perhaps around 3 to 3.5% in growth overall, with 1% to 2% of that being real. As it relates to the Fed, the Fed has implemented, as Zach was showing on the slide, the Fed's interest rate policy has been near zero. This is part of that quantitative easing that we're talking about, is also in terms of the interest rates. And the Fed has signaled that every intention of keeping that rate at about that near zero bound for the foreseeable future. And basically what Powell has said, what Chairman Powell has spoken to, is maintaining that policy, that interest rate policy at the Fed rate, until the economy is on a solid footing. And so they're projecting that this policy, this near zero interest rate policy, may well be in place for the next couple of years. It could be beyond that. It's just going to depend on how things play out in the economy. On their interest rate target, what they've also indicated, what Powell has also spoken to, is while they have a 2% target, they may well allow that target to rise above that 2% threshold. So they're going to be flexible in their policy practices. Let me touch on unemployment. Clearly a big issue throughout the country today. We, at the trough, we saw unemployment reach a level of 14.7%, which is, is worse than we saw during the financial crisis. There has been a significant rebound as the economy has reopened. Today, the most recent numbers we saw were somewhat below 7%. Those numbers were published somewhat before this more recent surge. And so projections today are that we may see unemployment numbers at year end somewhere in the 7 to 8% range. Obviously, that depends upon the success we're going to have in combating the crisis, and with the rollout of the vaccine and again a continuing reopening of the economy. On Fed actions, as I said, the Fed is holding their rate policy and anticipates that will continue for the next couple years. And then finally, let me just touch on briefly trade policy, which is that we can expect that there will likely be some shift in trade policy. I think the Biden administration is likely to reduce or eliminate the trade tariffs that were imposed upon China. Now, it's not clear what the administration's policy toward China in general will be. But I think as it relates to trade policy, both with China and other trading partners, perhaps a more liberalization relative to what the Trump administration posture has been to this point. And let me stop there and turn it back to you, Sarah.
Kevin, let's talk a little bit about regulation. How do you see the regulation from the governmental perspective changing or staying the same going forward?
Well, the Trump administration eliminated a lot of regulation in a variety of areas. Business responded favorably to many of those. Many of the purpose of elimination of regulation was to free business, and I think much of that will remain in place. However, where we do expect to see a marked shift in policy as it relates to regulation is in the area of environment and climate. And I think the Biden administration, Biden has spoken to the intent to take more measure to protect the environment and to re-engage with the global community around climate change and environmental policy. So I think that's really where we can anticipate change. I think in many other areas, at least in the near term, I don't think regulatory change as it relates to business outside environment and climate is likely to see it be a priority in the first year or perhaps even two of the administration.
Thanks for that summary, Kevin. Sabrina, can you talk a little bit about what you're seeing in the markets and how that relates to everything that Kevin was just describing?
Sure. I would say one of the biggest or most common questions that I get from clients is, gosh, there really seems to be a disconnect with the economy, what Kevin was just talking about, and what's going on in the markets. So when clients or folks are walking around their neighborhood, they're seeing small businesses are closed, restaurants and bars are boarded up, and yet the market continues to rally. And so this is really the phenomena that can be described as maybe Main Street and Wall Street. And the economy is really backward looking. It's how did we get to where we are today, whereas the market is forward looking. What are we anticipating 9 to 12 months out? The market is a voting machine. So for every seller, there must be a buyer, and for every buyer, there must be a seller. And so as we see prices, at least in the short term, fluctuate, what we're seeing is essentially that investors are feeling more positive about where we will be 9 to 12 months from now than where we are today. A la some of the news that we were just talking about around potential vaccines for COVID. So really the question becomes, okay, then how do we get from here to there? And what will that bridge look like? What needs to happen so that the economy can kind of get back on its feet? And if we recall earlier in the year, I think that there were some real learnings from the 07 to 09 downturn. So the need to essentially act quickly, swiftly, and meaningfully. And so earlier in the year, the Fed had stepped in as prices were declining within the market. The Fed stepped in and was very aggressive on lowering interest rates. So that benefits both individuals, private companies, but also publicly traded companies within the marketplace, having access to capital at lower interest rates. The Fed had also stepped in for bond buybacks. So as there were liquidity concerns and making sure that the market was continuing to operate without liquidity issues, so that as people went to go sell securities or sell bonds, that they would be able to sell those at a fair price for what was happening within the marketplace. And for the first time ever, the Fed had committed to also doing high yield corporate buybacks. So that was new this downturn. The other piece was the government stepping in with a meaningful stimulus package earlier in the year. So unemployment, as Kevin mentioned, was at all-time highs. This included both the $1,200 direct dollars in people's pockets for those that needed it, so under certain income brackets, as well as for those who are on unemployment, up to an extra $600 per week. And there were also the PPP loans. So I think the real question now is what might be on the horizon between now and next year when we do really have a solid plan for COVID. Part of that is an additional stimulus package likely? I would say before year end, sort of two reasons that we might see something come about would be one, the economy needs it, and two, Biden is in favor of it. Although keep in mind that Congress passes that, not the president, for any sort of stimulus measures. And so, of course, the two, I would say, factors that may prevent it, and I know we'll get into more detail on this, are one, the delta between what the Democrats and the Republicans are proposing, as well as having a potentially remaining split Congress. So in the meantime, the trends that we've seen, obviously earlier in the year, pretty much equities across the board were in negative territory, double digits, down 20 to 30%. Since then, we've really seen with some of these actions that both the Fed and the government have taken, the US markets are leading the rally for the recovery. But more recently, just in the last couple of weeks, we've seen some nice appreciation within foreign markets and especially within emerging markets. The pieces of the portfolio that we're continuing to keep an eye on, especially are in the real estate area. So this idea of, okay, if office space isn't being used in the same way, a lot of people are working from home, people aren't necessarily traveling and going to hotels or retail, in-person shopping malls. So these are all segments of the real estate allocation. Now, keeping in mind, real estate was the best performing asset class coming out of last year, that in US markets. And this year, we've seen the weakest recovery in that area, although within our real estate allocation now, we have roughly about a third in infrastructure. So these are segments like cell phone towers, data centers, laboratories. So areas of the real estate market that will continue to produce returns during this period of time. And we don't think that real estate is going anywhere, but it is cyclical.
That's helpful to hear. And what I'm hearing you say overall, Sabrina, is that the Fed actions this downturn were significant, had a huge impact. The stimulus packages have been meaningful, and diversification is showing its colors again this year, as it does in any given year, with some asset classes performing very well and others not performing quite as well. And we'll talk about more opportunities as we talk further. Thank you for that. Zach, I'd love to hear a little bit. We've heard this question from clients consistently. Why was it that markets responded so positively during the week of the election?
Yeah, absolutely. And I'm going to go ahead and start back here with this slide and just kind of highlight this period right here, which is really, encompasses the election, the week before the election itself, And I think it really goes back to, markets don't like uncertainty. And, leading up to the election, there was this idea that maybe there's going to be, it's going to be a contested election. We don't really know the outcome. We don't know, how certain candidates are going to react to the outcome, et cetera. And then what we really started to see is, again, kind of seeing through some of the noise of, yes, there was a vaccine, but also we started to have a more clear outcome in terms of what the election was going to look like and who the candidate was going to, or who the winner was going to be. A lot of that election uncertainty subsided. And then, as I previously commented, again, it was that split Congress. And I know that we had a question come through here in the Q&A, asking about whether or not some of that volatility and whether or not the market rallying was due in part to there being, no clear sort of winner or no one kind of dominating either the administration or in Congress, either Republican or Democrat. And so having that split Congress might have, tempered some of those policy expectations that were being priced into the market. And I want to move on to these next couple of slides here as well, because I think, adding some historical context to how the market has moved regardless of who is in president and regardless of who is in Congress, who's in control of Congress, or whether or not it's a split Congress. I think the major takeaway to take, that you could gather from this slide and the next slide is the market has rewarded investors over the long term and disciplined investors over the long term. And while policy does have an impact on the market and maybe, the underlying corporations, the underlying economy, the market has been rather agnostic to who is in power, and whether that's the president or, looking at this next slide, Congress as well. So again, I think it's important to always fall back on that principle of being disciplined, being strategic in your thinking and in your investing. And again, the market has rewarded those who have remained invested over the long term.
It's reassuring to hear that, Zach, just that regardless of who is president, who is controlling Congress, that markets have always found a way to be successful, to be effective, and to grow long term. Speaking of where we're headed going forward, let's talk about COVID. We know a vaccine is coming. We also know cases are going up significantly now. Kevin, tell us about what happens between now and when those vaccines actually arrive.
Well, I mean, the recent surge, obviously new lockdowns and in many areas, mask mandates are happening. And it seems reasonable to expect that even with the knowledge of the vaccine coming, given where we are today, given the surge in infections throughout much of the country, that those types of initiatives, specifically the partial lockdowns in some areas of the economy, whether it's gyms, restaurants, et cetera, along with either encouragement or in some cases a mandate that people wear masks and socially distance. Those are likely to continue for the near term. I mean, the rollout of a vaccine is going to take a period of time. There's a lot of encouraging trends, but that's still going to be the dynamic. It does not appear, thinking about at the national level, I think Biden has essentially come out to say that he does not envision any national lockdown, but may in fact advocate or recommend or pursue some type of mask mandate. As to the possibility of future stimulus, right now, with the split Congress that we have, what we don't know is the outcome of the Georgia elections. But what we do have today is a Republican Senate and a Democratic House, and that will remain so into the next year. Given that, I mean, there is, and Sabrina touched on this, there's a chasm between what, as an example, Senate Leader McConnell has spoken to versus the Democratic House, which passed a $2 trillion measure. McConnell is talking about $500 billion. So there is a huge disparity. It's not clear whether there will be, whether action will be taken to implement a stimulus before the end of the year. Obviously, there's a great need. And so that remains an uncertainty. Stimulus will undoubtedly be passed. What the specifics of that look like and the timing of that still remain uncertain at this point. I commented on the Georgia Senate, as did Sabrina. Right now, if you look at the history of Georgia's voting, it would be likely that at least one and perhaps both Georgia Senate seats will go Republican. The election, the runoff occurs in January, so we won't know that answer before then, which is one of the things that may play out in terms of delaying the stimulus measure. But unless the Democrats sweep both seats, which at this point seems unlikely, barring that sweep, then the Senate will remain under the control of the Republican Party. So, given that, relative to the House measure of $2 trillion of stimulus, it's likely that stimulus will be more muted than the House's original pass. We'll see where negotiations take place. Both McConnell and Pelosi it will negotiate, and they're hard bargainers, and so I think it's quite likely that there will be a great deal of hard bargaining ahead. Having Biden in the presidency will certainly influence that, and he has a history of being able to reach across the aisle and successfully lead to an agreement. So we can probably be somewhat optimistic in that regard. So having said that, we need to look at the Federal Reserve's willingness to continue to backstop the economy, their limitations on what they can do. And I think one of the real benefits, or if you will, one of the real keys to the recovery that we've had to this point has been the stimulus. And so there's going to be a good deal of pressure on Congress to enact something because there are inherently limits on what the Fed can do. That said, the Fed will continue to, as we discussed earlier, maintain its near zero bound interest rate policy, along with providing easing in other areas. And Sabrina talked about the purchasing of corporate bonds as one of those key changes that the Fed will continue to pursue to support the economy as much as it can.
Sabrina, can you again tie in what Kevin's describing as happening out there with what you see happening in the future for markets?
I think that the key word for me really is that unknowns, right? There are still a number of unknowns, and some of these actions that are being taken by the Fed and the government are really they're propping up the market. And so what's happening is the market isn't necessarily able to move in what we would call a typical market cycle. So what does that mean for us in portfolios? I think it's really underscored the idea that you can't outguess the market. So we believe that markets are efficient and digest information in real time. And so what that means for us is continuing to stick with a disciplined approach, setting the targets in the asset classes that we want to be invested in and with market exposure there, and then consistently rebalancing. As Zach was describing earlier this year, that meant selling bonds and buying stocks as the market was declining in value so that we had more shares participating. More recently, what it's meant with the run up in some of the areas that I was describing on the equity side is selling off those particular asset classes and then reinvesting in asset classes like real estate that is undervalued at this time. So continuing to look for those opportunities as we move into the new year. I'd say that the additional piece is making sure that in certain segments of the portfolio that we're positioned in a way that helps us sort of regardless of what's going on in the overall environment. So specifically, like with lower interest rates within our bond allocation, we have domestic bonds, we have international bonds, we have treasury inflation protected bonds. we have high yield, and we have emerging market bonds. So looking at how do we diversify exposure to maximize the amount of interest that we're and income that we're generating for clients in this bond segment of their portfolio. The other piece is the alternatives. We continue to like alternatives from an academic standpoint, and we really think of alternatives in the portfolio. So we have traditional bonds and stocks, and this is a third bucket really to help with downside protection. So these are assets that don't necessarily move in tandem with stocks or bonds. So they're not moving in lockstep. They're not negatively correlated, but they have low or no correlation, which means that if stocks are moving in a downward direction, these assets can be producing returns during that time. They may be having positive returns while the market is up, or negative, but what they're doing is providing a bit of a buffer. So for example, there are a number of different strategies that we employ through the funds that we're holding in the alternative space, but one of the sectors or sleeves, if you will, is mergers and acquisitions. So in a year where we've had really tough market conditions, one could ask, gosh, mergers and acquisitions, haven't those kind of come to a grinding halt? Well, in reality, market conditions that are potentially adverse, it means that some companies aren't doing as well, and other companies that do have really strong balance sheets have an opportunity to step in and purchase those other companies. So that would be an example where a merger or acquisition can come into play, whether the overall market is up or down.
Sabrina, you mentioned something there, and I kind of want to piggyback off of it. In terms of how we're positioning our portfolio, sometimes we get questions from clients regarding, okay, we know what's doing poorly or what's doing well in this market environment. Why aren't you tilting our portfolios, or why aren't you doing an active overweight to, XYZ industry? And one thing that really draws on for me is our multi-factor approach. We don't necessarily take an active overweight to specific sectors, but one thing that our momentum premium does in our portfolio is it looks at those things that are doing well relative to the rest of the market, or poor relative to the rest of the market, and either overweights or underweights those sectors. So what we saw back in spring, I'd mentioned that kind of oil sell-off in the face of that demand shock. Our portfolios sort of divested from energy and were tilted away from the energy sector, which was doing poorly. And then on the flip side of that, we were able to overweight things that were doing well, like pharmaceuticals or some of those stay-at-home stocks in the technology sector. Another one of the factors that we have in our multi-factor, in sort of the multi-factor approach, is quality or profitability. And you had mentioned, those companies that have stronger balance sheets might be doing better during this period. Well, that's what that factor looks at. Those companies that have strong and consistent earnings, as well as strong balance sheets, we're going to overweight those securities in our portfolio. We might not be doing this by buying an ETF that's dedicated specifically to energy, but what we're doing is we're doing this in a systematic way, utilizing different indicators and factors to help us tilt that direction. So again, it's more of a systematic process, and it kind of goes on behind the scenes as our fund managers are really in charge of that process. So it is happening in our portfolios, and there are tilts and overweights that we do and act, but it's done through that multi-factor approach.
It's helpful to hear about those opportunities that are in the market and how we're taking advantage of them in portfolios too. Can we turn our attention to taxes? And I'd love to hear some context from you, Zach, about what U.S. tax policy has been historically before we look at what it might be going forward.
Yeah, absolutely. And I have a couple of slides here that I think will help sort of frame the historical tax rates. So looking at, some of these earlier periods, we got up to 94% was the highest individual tax rate in history. If we look down here in terms of capital gains taxes, these were really enacted in the mid 30s. and raised throughout more the war period as we're coming out of World War II to help with some of those government programs and the government spending that took place during that period. But even, even now, looking at this graph relative to history, we're in a relatively low tax environment. Um, and so you have the highest individual tax rate sitting at 37%. The corporate tax rate obviously came down to 21% from 35%. And then the capital gains tax rates for individuals is 20% more recently. And so relative to history, capital gains rates are relatively in line with the historical average. Corporate tax rates, obviously there's a period really starting here in the 70s where there was kind of an increase in the corporate tax rate, but obviously more recently that has come back down. So again, I think it's important to look at history and use history as a guide to where we really sit in terms of tax rates. And the same can be said too for the estate tax and the estate tax exemption. So looking back over history, we really started to see an increase both in the exemption amount and a decrease in the rates. So really starting in the early 1970s and more, and that trend continued through the recent period. So we're really, again, from a historical standpoint, low in terms of estate taxes on a percentage basis, and then also relatively high in terms of what that threshold or what that exemption amount actually is.
So Kevin, with the existing Tax Cuts and Jobs Act of 2017 currently in place, what can we expect to see on the tax front?
Well, I mean, first off, as a starting point, it's important to remember that the provisions of the 2017 Tax Act all sunset, at least on the personal side, and I'll speak to that. The corporate side is essentially the tax changes that were enacted in 2017 on the corporate side are permanent. And there are a couple of provisions that sunset over the next few years, but those are relatively modest. The fundamental rates remain intact and not subject to change without some type of legislative action. On the personal side, it's a different picture. All of the personal tax reductions, tax changes that were enacted in 2017, effective 2018, will in fact sunset. They will revert back to the 2017 levels beginning in 2025. 2026? Excuse me, in 2026. I have to get my years straight on that one. But so, given this, there's nothing on the horizon, and particularly with a split Congress. There's nothing on the horizon that is where we're likely to see meaningful changes in tax legislation in the near term. And I would say that's a probability or a likelihood, certainly through to the midterm elections in 2022. There may be some provisions on the margin that are reviewed and subject to change. But basically, the personal tax rates, the changes in deductions, all of the changes that were initiated, along with changes in the estate tax exemption, those are all likely to continue, certainly for the next couple of years, and we'll look at what happens following the midterm elections. And so, presuming a split Congress, it's probably the tax landscape is likely to continue as it currently exists into the next few years.
Might some of those sunset provisions, Kevin, work well for some of our clients, especially those in California?
Without question, and in fact, that's an important point to bring up. That if we look at the sunset provisions, one of the changes that was enacted were the significant change in what is deductible. And so, as a reminder, the terminology is state and local taxes, or SALT taxes, and that would be property tax and state income tax. And in a state like California, what we see is that allowance, if you will, for SALT tax deductions is $10,000. And, unfortunately, for many California property owners, and particularly those in the Bay Area, 10,000 doesn't even cover what you're paying in property tax, let alone what you may be subject to in income tax. So the effect of the changes was significant as it related to significantly reducing what California taxpayers, in particular, those on the coast, on either coast, is where we saw the greatest change, but what they were able to deduct. That also changed what were allowed, personal exemptions went away. So those kinds of changes, if they in fact sunset and we revert back, actually will probably have a beneficial effect for the highest income taxpayers.
Okay. So it sounds like with a split Congress, it's unlikely that we'll see significant tax legislation, more likely the sunsetting of existing provisions. Sabrina, can you speak to the event of a Democratic controlled Congress, which is, we see as being less likely?
But if it did come into play, some of the tax proposals that Biden has put out there could be enacted. So some of those are around on the individual side. There's been a lot of talk about raising individual rates, especially for those households earning 400K combined and above. So that's really the top 20% of earners. Although there could be some possible trade-offs, so the tax rates might be higher, but you could get some of those deductions back. The other piece would be around capital gains. So for those earning $1 million and more, that could go to an ordinary income rate. That would be a pretty significant increase. The other one is on the estate tax exemption amount. So Zach had shown the screen earlier, the chart earlier. Right now we're at 11 million plus per person. And that could revert as low as there's been talk around bringing that back down to 3.5 million. In 2026, it reverts to the 5 million, which was the pre-2017 number plus inflation. So we know that we're going to there, but it could go as low as 3.5 million. And then I think that the final one is just around corporate tax rates. So a lot of talk around right now, the rate is at 21%, moving that back up to probably 28%. Again, keeping in mind that that was at 35% previously. But the piece that's really interesting, I think, on the corporate tax side that we don't hear a lot about is that corporations, well, we get the question around, gosh, if tax rates go up for corporations, doesn't that mean that there could be a pullback in the market, at least in the short term? And I think that that's exactly right. There will be a period of time where companies are digesting that information, but ultimately publicly traded companies have to deliver shareholder value and be profitable. And so what's one way that they can do that? They will manage their expense line items. And one of those is around wages. So what it could imply is that going forward, if corporate tax rates go up, that wages stay low, that we don't see that wage inflation pick up. And we've been in this low wage environment probably for the last roughly 10 years, and moving into 2020, unemployment had been low. There had been a lot of pent up demand. So we were expecting wages to pick up this year, and they just haven't. So I think that's a factor that could be on the horizon as part of potential tax changes. So what does all of this mean? Even though these pieces are pretty unlikely that we'll see any change moving into 2021, I think that the opportunities, we're coming up here on year end. Within the next couple of weeks, for clients, they'll have year-to-date gain loss information posted into their portals and can access that along with tax projected dividends and distributions through year end. So for any tax planning that needs to be done before year end, which could be things like Roth conversions, donating in-kind stock, and taking advantage of sort of any sort of items that may need to be addressed before year end. Interestingly, before the election, we did see a number of clients with larger taxable estates. So again, that's in that 22 million plus range, looking to potentially accelerate gifts before the exemption amounts were lowered. But I think that we're seeing a bit of a pumping of the brakes on that one, and it's more of a wait and see. And as long as you're not looking to make gifts above the what could revert to 5 million plus, 5 years out, then gifts could be made moving into next year. But I think the important piece there is being in contact with your attorney and your advisor to make sure, are there any steps that need to be taken before year end?
Great advice on what to think about and how to approach things before we get to December 31. So that wraps up. We've covered 2020 in a brief history. We've talked about where we're at currently in the markets, the economic, the political landscape, and also with regard to COVID. And we've also looked forward. What can we expect from markets? What can we expect from an income tax and estate tax perspective, given some as yet to be determined issues around who is passing and making legislation? So I just want to thank you, Sabrina and Kevin and Zach, for sharing your wisdom, for sharing your insights today. That's really helpful to hear your perspectives. And for those in the audience, we hope you found this conversation valuable. We hope you found it helpful. We are sending the questions you sent before today's webcast and also that you submitted on Q&A to your advisors directly. We also encourage you to connect with your advisor with any follow-up questions that might be on your mind too. We've recorded the session and we'll make it available to you. And as you look forward to spending time with your friends and family next week, even if that's virtually, know that we're here for you. We're here for the people you love too. We found many folks are looking for someone to talk with about their finances right now, and we're happy to be a resource for them. So thank you for joining us and happy Thanksgiving.